Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Nick Chirls, GP at Asylum Ventures, a newly launched early-stage venture firm celebrating the creative act of building startups.
And I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers, both emerging and established franchise VCs. And I'm really excited for today's conversation with Alex Edelson, a founder and LP investor at Slipstream Investors.
Alex started his career as a lawyer, practicing law for 7 years before pivoting to VC. He spent over 2 years at QED Investors, initially as Nigel Morris's chief of staff before becoming chief operating officer and general counsel. That's where I met him myself while he was at QED. And in 2021, he branched out and founded his own firm, Slipstream Investors. We spent a little time together around then and have gotten to know each other in the last few years. Beezer, you probably meet more of these. I have not met that many folks starting fund of funds from the ground up in the last few years. And so really excited to dig in with Alex and understand what that means, why he did it. And I think his investing is perhaps a little bit different than some of the other fund of funds that we've met recently. Rather than focus on big brands, his philosophy at Slipstream is that small, early stage funds are the key to unlocking investor value. And he's specialized specifically in funds that are difficult to find, evaluate, and access.
I am so excited to talk to him for 2 reasons. Actually, 3. He's awesome. Super fun, interesting person. 2, you are right. It is. It is not easy to start any kind of venture fund. It is very hard as well to start a fund of funds for reasons we can let him explain. And so huge props to him for doing that. And also, I'm so excited to have him talk right now. I mean, I know you know the beauty and glory of small, dedicated, early stage funds, but we can stick this in the show notes, just did it. And we being Sapphire, and my colleague Evan is the hero of this, just looked at thousands of early stage data points to look at what's going on in the current early stage market, because there's been a lot of talk of who's winning the deals. Is it these giant, big mega funds? Is it dedicated funds like yours? And the short of it is everybody's doing them. So there is not, no one owns the early stage world, which is good news for all of us, I think. But it definitely kind of brings into the conversation of, if you're only doing dedicated small funds, what's his take on this play? Because some LPs split the difference and do both, some don't. I don't know. It's just all super, super awesome timing. Thank you for inviting Alex. I really appreciate it.
I think this is going to be awesome. Let's do it. Let's go.
Let's go.
Alex, this is fun. Thanks for joining us.
No, thank you guys. This for me is it's a long time listener, first time caller experience, because I have been listening to you guys, I think since before I started Slipstream. I've been listening to this podcast. So anyway, I'm a big fan of what you guys have built. I feel like it's so valuable for the LP and GP ecosystem, and honored to be a part of it. Thanks for thinking of me.
Thank you for listening. I know I was going to say,
thank you.
That was awesome.
Yeah. Future guests, take note. So, Alex, we met a couple years ago. I think probably around the time you were starting Slipstream. One of the things that struck me was, in many ways, I think you carry the same ethos as any early stage manager or any newer manager. But I think the best place to start is, why did you start Slipstream? It's damn hard to start a fund of funds. Why are you doing this?
I did this for a few reasons. The context here, of course, though, is like, I was a lawyer. I tried to get out of law for many years. I then joined a friend's 2-year-old startup that didn't work out as we hoped. I found my way to QED. The mission was like not to be an LP one day or start something like Slipstream. Like, the mission at that time was like, get this ship pointed in the right direction so that I'm doing things that energize me and are like a better use of my skill set and personality. But another piece of context, like, a lot of people discouraged me from doing this. Like, they saying this is an outdated concept, and like, no one wants to pay a second layer of fees. And at that time, like, the market was very hot. And I think people felt like their portfolios, their venture portfolios, were performing like they didn't need help. And maybe we don't need a fund of funds. We can do this on our own. And what I saw was, like, venture has the biggest dispersion of returns of any asset class. A significant portion of the funds that top the asset class are these small funds run by emerging managers who have limited track records. It's hard to source the best ones. It's hard to evaluate these because of their limited track records. It's hard to get access to some of the best funds. It requires a deep network of like VCs and founders and expertise about venture and a lot of time meeting like hundreds of managers a year. And I looked around the ecosystem at that time, like when I'm thinking about what's next for me, like I'm thinking like it's time for me to move on from QED. What am I going to do next? And this was an idea that had been building in my mind for many years. And part of it was like, I was realizing like we at QED had this like unique perspective about what it takes to increase the odds of outperforming an early stage venture. And I had lots of learnings from that. And we had success and failure that we were learning from. And just like being there and like seeing under the hood of how a great, still relatively small early stage fund increases their odds of outperforming. Like, I realized like, hey, I already know many emerging managers. We're working with these emerging managers around the world. Like I'm realizing we have opinions. I have opinions about which ones are good in terms of their ability as investors. And it doesn't always correspond to their ability to fundraise. And so that was like a big moment for me when I was like, man, this is a very difficult part of the asset class for potential LPs to invest. And like, maybe I have something here because I've learned this at QED and I have opinions about who's good and they differ from others in the market. And then over time, I was realizing like, oh no, like early indications are we're right. And then like, since then, like as those matures, as the track records of those folks has matured, like it's sort of further emboldened me. Like I think we were onto something and we were seeing things sometimes that other LPs were seeing, but sometimes like these were not consensus funds and they have turned out to be great funds. And so then like, I'm realizing like I'm building relationships with these funds. Like, I think I can access these funds. These folks are like asking me for help sometimes. And I'm like, I'm just a lawyer. I don't have a clue what I'm doing in venture. And they're like, they want to talk portfolio construction and all these other things. I'm like building a flywheel with them. Like I'm meeting their friends and I'm like a safe place for them to talk and get help. And I was sort of putting this together. I'm like, man, this is like kind of an overlooked part of the asset class. It's really hard for people to figure it out. It's not worth some of these LPs' time. It's too small. The checks are too small. You can't put enough money to work. And so I was like, man, I have so much fun when I'm on the phone with these emerging managers at QED, like talking to them. Like, man, I think there's something really unique here about what I could build.
So I think we specifically on Origins, we've talked at length about certainly how founders raise capital. We've had a bunch of founders on the show over the years and had a lot of GPs, particularly through the lens of how they build firms and how they're raising capital. I don't think we've actually really talked at length about LP fundraising.
I don't think we have.
Like every person every person in the stack I find is like sometimes surprised that the person above them in the stack also has to raise capital. And so like I think it would be helpful, Alex, for everybody to understand like how do you actually start a fund of funds? Like what does that mean? And how do you raise capital for it?
Okay. Yeah, good questions. So one thing that's interesting is like there's like sort of a daunting component to starting an investment firm, because typically when you start it, you're an investor and you haven't necessarily run it or set it up in your prior experience. And so for me, I was lucky because the COO role at QED was like kind of being involved in running QED from on a day-to-day basis. And I was involved in some of the legal work there too. And so I was actually pretty comfortable with back office stuff. Like, hey, here are the vendors I'm going to need. Like, we're going to need a fund admin and we're going to need an accountant and we're going to need outside counsel and the type of team I might want to build over time. Like maybe we're going to start with a fractional CFO and some operational support. And I had some experience with investor relations and fundraising and some of the fund formation elements that like everyone works through when they set up a firm. Although I did not have experience setting up a fund of fund. I had experience setting up a direct venture fund.
If you want to elaborate a tiny bit on that, I don't think people appreciate how complicated or busy the back office is for a fund of funds. And maybe this is too in the weeds, but most people who tell me they want to start a fund of funds, I'm like, you got to really think about your back office and your financial accounting and recycling. And again, this is in the weeds, but it's no joke.
Yeah, no, it's no joke. And I had a lot of learning to do on that front. Like I had a sense for what it takes to run a venture firm. And a lot of that is similar to what it takes to start or run a fund of funds. But there are plenty of differences that are important and like can impact returns. Like you're mentioning, like, yeah, are you going to overcommit? Are you going to recycle? Like your portfolio construction. We had great LPs at QED while I was there. They included some really sophisticated fund of funds. So I had folks who I was close with and could go to talk about some of those topics. And what was interesting was like the range of answers I got on some of these things. But it was also exciting because I felt like for some of these things, there's no one answer. I can build this how I want to build this. And I have a lot of interesting data points and I have this QED experience to build on. But yeah, some of this was foreign to me. And like fund formation in particular, like if you just work with a lawyer who does fund formation for venture funds, they may not be well positioned to address all of the issues that you're going to face as a fund. And that was important to get right.
Could you also talk about, and again, this is a bit of a niche LP situation, but it's legit hard. One of the reasons why it's so hard to both start and continue a fund of funds is the layering of fees. And then how does one fundraise? How does one address that? Back in the day, there used to be thicker fees. Always. So just for context, it used to be VCs were 2 and 20. Now VCs are a range, right? Some are still 2 and 20. Some are more expensive on the management fee and the carry. And it used to be fund of funds was more, I don't know, what do you think, Alex? 1 in 10? I mean, historically, that felt more germane. But now to get 1 in 10, you see a lot of co-investments and other activities. And there's a lot of pressure to bring down the fees because when you layer the fees, it makes the return for the ultimate LP muted by the cost of the fees unless there's overperformance. So that's just a little bit of math. But it's one of the reasons why it's really stops people from raising fund of funds or people can't continue, right?
Market fees now are 1 in 5.
Can be. It depends. Sometimes it's under 1.
I've seen it lower.
Yeah. It depends on
I've
the
seen it under 1.
size. It's like the same thing with VCs.
Wow.
If you're going to
Okay.
raise inside baseball, if you're raising billions of dollars, the odds are you have some LPs that are writing you 100 million plus checks and they're getting reduced fees. And the same thing can be true in fund to fund lands because you'll see pensions and other folks that have to publicly disclose their fees get a lot of pressure from the private equity side to not, because then in those cases, sometimes they pay fees per deal's done. And the general pressure on fees pushes down into venture land. And you could argue it's apples and oranges, but it doesn't matter. There's still pressure in the market. And then it also goes to people don't think they need help. And so when they don't think they need help and it mutes your returns to get help, that's hard to sell against. So huge props to you. Huge props.
Yes.
And to the extent you're willing to
Totally
share the
right.
magic, share the magic.
Not that I have the magic, but I'll tell you how I think about it. I can tell someone all the reasons to invest in Slipstream, and it's like, but I'm also going to tell you the reasons not to invest in Slipstream. And like, this is on the list, and I will lean into this because I think I want everyone to think about the investment decision from a complete perspective. And I don't want anyone to be surprised by anything. Look, if you think you can get exposure to like the best venture-backed company directly, like I guess you should do that. And like, if not, but you think you can get exposure to like great venture funds, then like directly without me, you should do that. And if you can't, but you want exposure to great venture funds and you need some degree of help, either like completely outsourcing it to us or outsourcing it in part, and we'll kind of partner with you and help you build out your venture portfolio, like that, then maybe it starts to make sense. Because if you take as true that like the returns here are better than any other asset class, if you're in the right funds, then there's probably a place in your portfolio for venture. And the question is just like, can you get those funds on your own or not? And if you can't, then I think these funds should perform at a level that our fund should perform, even if we are charging an extra layer of fees and carry. But like a few additional points here. One is we need to structure our fund and our portfolio in a way that can also outperform. Like if I was just going to go out and invest in 50 funds, I think it would be very hard for us to generate the types of returns that would warrant anyone investing in Slipstream. So like we need to be concentrated. We're focused on, risk on funds that can really generate great returns. We're probably as or more concentrated than anyone in the market.
Which from your perspective is what? What does that mean in terms of how many funds?
Oh, like 90% of our capital is in like 10 to 12, 10 to 13 funds.
Got it. Yep.
So there aren't maybe there's one that's more concentrated. There aren't many
typically
people
like 15 to 20, something like that.
And some of the bigger firms are like much more. It could be 30 to 40. And so, and Beezer, yeah, I mean, I'd love to hear your thoughts on this too.
You're relatively speaking, very concentrated.
Yeah. And so one other thing is like we overcommit, right? So like we're investing through our fees and expenses, but there still is carry, and like that is that will impact returns. But I do think when you model it out, like these can still be great returns if you're in the right funds and you're concentrated enough in them.
So Slipstream is getting going. I want to know, like, where did you're like, okay, I'm going to start this fund of funds. Who do you go talk to? Is it similar to like an early stage venture fund, institutions or people or GPs, or like where do you start? Is it the same people that GPs would be pitching to?
I think it's pretty similar. Like I started with my personal network. It's people who I've worked with before. It's people who know me and believe in me. I'm not like reaching out to people cold. I'm not like going to events and trying to persuade people in the drinks line. Like I'm just working my network, and it includes, like people in venture. It includes operators, VCs. It includes high net worth. It includes some family offices, but like at that point, not a ton of family offices. It did not include any institutional LPs. I mean, really, those were more like friends through like QED's LPs, not like pitching them, more just like learning from them, getting their thoughts and advice on what I was getting started. And then like I worked out from there, but it's like, oh, your early believers who know you and trust you and think you're great, they know this other person and they know that family office and they know, this group that might be interested. But yeah, it felt very much like a fund one that an emerging manager starts today from a fundraising perspective. I mean, there are similarities and differences, but there are more similarities, I think.
Yeah. And for what it's worth, it's one of the things that I think resonated with me, and I'm sure other managers, is that, you're also doing it. There's a level of understanding, empathy, that, is hard to find in.
A million years ago, when I was looking to move from being a GP to an LP, another LP who had come up through a more, I guess, traditional LP background, I'm not entirely sure what that is, but it was more sort of like start working in an endowment foundation and continue up that track. They said to me, no one's going to trust you because you used to be a GP and you will then be biased towards the GP versus the LP, which I thought was a kind of an odd statement, because ideally you should be aligned, right? So the whole concept of it being biased was weird. But then I thought exactly what you thought, Alex, which is, but wait, I understand how this whole thing works. And I've seen inside the shop. And isn't that really actually helpful? I'm so intrigued by the comment you made about you saw people that were non-consensus, but really doing a good job, but having a hard time fundraising. Because when you see that, you're like, well, I could invest in that. And you only see that if you're inside. It's very hard to see it from the outside. So that, I don't know, what you said just really resonated to me on that level.
I wonder though if that LP, is represent, not now. Maybe one day. I do think that probably reflects also change in market dynamics, like change in power structure. Like a long time ago, like, it didn't matter as much if you could identify with the founder as a VC. Now much more competitive. Now you're selling, so you want to build rapport and empathy and understanding. And I wonder if the same is true with LP GP. Like once upon a time, it was like if you had money as an LP, like that was fine, that was enough. And now there needs to be something more understanding with the GP and a deeper, sense of who they are and how they need help. And so, curious to understand if you guys think maybe that is reflective of also where the market structure is today.
Yeah, I mean, it definitely resonates with me. I think it's like a big part of me even starting this in the first place. Like you hear VCs say all the time, I was a founder and I'm just the VC I wanted to work with when I was a founder. And that gives me advantages when it comes to basically every part of this job. And so, I think like I feel the same way. It's like, look, I want to be the LP that we wanted to work with at QED. Like those were not the easiest funds to access. Like we were choosing LPs and like I had strong feelings and I saw other people respond to our LPs too, but I had strong feelings about like, what's a good LP? What's a great LP? What's the LP we reach out to when we have questions? What types of questions do we reach out to them about? What's like the tone that people take with us? Like, are they pushy? Are they deferential? Are they trusting? Are they giving us their feedback? Do we know where we stand with them? Like, are they talking about our relationship in a long-term way? Like, are they transparent and responsive? Like, there are things that LPs were doing with us that drew us to them. And that to me, like became a model and I think it's an advantage. Like I can just be the LP I wanted as a GP. And I think it helps with the whole, with every part of my job now. Beezer, you must feel the same way.
Yes. Yes. And it's so, God, there's so many parallels. And Nick, thank you for articulating that, because you've now answered a question that's been in my head for probably 20 years. So that was very helpful.
Wow. Thanks.
I've also found, and I'm sure this is similar, if I ask 5 GPs what they want in an LP, besides there's some obvious ones, like please have money available whenever I want it. Please don't be horrible, whatever their definition of horrible is. But some people like a lot of engagement. Some people are in the, hey, I'll talk to you twice a year, or hey, just come to the annual meeting. It's good. So what people want varies. So it's intriguing as you try to, and I'm sure it's similar with GP and founder, it's intriguing as you try to chart your course of what do we stand for besides money that we feel is true to our special powers, but also you don't get wagged by everything in the world because honestly, then you're just following it. It doesn't, should say it more completely. I think when there's a wonderfulness about being responsive, but if you don't know who you are as an investor, you lose the magic. And I see GPs, if we want to bridge to the market today, I see GPs and maybe Nick, you see LPs really trying to figure out what's going on in the market today because it's such a fast market. And there's just a lot of comparing to others versus looking within.
I think we're going all the way to the market, so we can come back. But if I were to rephrase your question, these are like in the simplest form, I would ask, what is similar and different today compared to 2021?
Oh, so interesting. Okay. So a few things. One, I am starting to hear this talk about like, we're just playing the game on the field. Oh yeah, no. I know these valuations are high, but this is ownership. These entry valuations are higher than we thought. The ownership we're getting is a little lower than we thought, but like we're playing the game on the field. We got to be in the best companies. It's all about access. And that's kind of scary to me because it almost pushes on like, what's your job as a VC? It's like, is your job to get exposure to the venture asset class for your LPs during a period of time? In which case, like sometimes we're better than others, and we're just going to accept this somewhat passively and do the best we can with the market conditions that we have today. Or is your job to get like venture scale returns? And if you think your job is to get venture scale returns, that has implications for like what you do when the market is hot. And it might mean you slow down. It might mean you tweak your strategy a bit, and hopefully in consultation with your LPs. Like in all cases, it's probably to like be open and transparent and very careful, because what we saw, like, as you'd expect, 23, 24 comes around. Even now, people look at what happened in 2020 to 22, like someone's raising a fund now, and I look at the funds that they deployed during that time. One thing that also stands out, maybe not as positively, is like people who were paying really high entry valuations or didn't seem as disciplined, or their pace changed and they deployed really quickly. And that can worry me now because it's like, hey, what am I getting? Am I getting someone who's super disciplined and focused on venture scale returns, or am I getting someone who's going to change as the market changes? And not to say that that's necessarily wrong, because we are all evolving as market conditions change. One similarity between now and then is that I'm starting to feel the tension between like playing the game on the field and getting venture scale, doing things that like can get venture scale returns. I think like, yeah, some of these valuations are similar to then, and some of the SPV activity seems like it's ramping up like it was back then.
How about deployment pace? Because in 2021, it got to like, funds being deployed in a year or something.
Yeah, I haven't seen that pick up much, but I'd be curious what Beezer says. And I'd be curious we'll see what the data shows like in a few quarters, but I haven't felt that in our portfolio. But maybe it's just too soon. Some differences that come to mind, just like off the top of my head, in 2020 to 2022, it felt like everyone was starting a fund. Like I felt like the pitch that I would get is like, oh, I cut, someone's hair who's like some super successful person in venture. And like, I hear them talking about venture. So now I have a $5 million fund. And I'm just like, guys, like, this is crazy. Why do you have a fund? I felt like I was having a lot of those conversations then with people who kind of like weren't investors. I don't feel that same volume of new fund ones right now. And fundraising does not feel like it is as frenzied. There are certainly like sort of the haves and have-nots in fundraising. We'll see if that actually corresponds to who generates returns, but I think that's always true. There are always, in all market conditions, still folks who raise very quickly, are heavily oversubscribed. I don't see the sort of feeding frenzy from LPs that I saw then, not yet at least.
Oh gosh, I loved how you articulated all of that. Thank you so much. No, you do not see an LP feeding frenzy. In fact, the numbers aren't done, so let's hope for more positivity towards smaller, focused emerging managers, because you're seeing a real drop off you're seeing a real drop off in the number of funds that close this year, full stop. You're seeing a lot of the really big funds, because they're really big, causation correlation, majority of the money is going into them, but you also would need a whole heck of a lot of smaller funds to equal 1 billion or 2 billion. So there's some of the math is just biased that way. Because a lot of LPs are still, and I'm going to tie this back to, actually it starts in 2019, they're still digesting all of the NAV that is sitting on their books in companies that may or may not ever matriculate out. And so you can't put new in until you have room in your NAV for more, and every LP is sort of dealing with it differently, because they're just, some of the NAVs are coming down because funds are writing them down. Some NAVs come down because they're actually exits. It's a whole mixed bag, but you generally speaking see not awesome vintages, generally speaking, for 2019 and 2020 because of what was going on in the market. So LPs are dealing with that, and that is definitely cooling the fundraising market. So it is really interesting. Is the biggest difference in the market is you're seeing a lot of venture activity, but you're not seeing a lot of LPs coming back. That said, there's still plenty of capital in the venture ecosystem. So as a founder, I do not worry about the strong founder at all. Strong founders can almost always raise, and there's plenty of capital sloshing around the venture world. So it depends on where you stand right now, which is, I find fascinating. Other lessons that it seems to me so bizarre, we're 4 to 5 years out and people haven't really digested these lessons. But to your point about the speed of vintage, there was a lot of deployment over a year, 18 months, which for the most part has not turned out well for folks. There'll always be some ventures power law. So I'm waiting for the one company that makes the 1 year vintage awesome. But so far, it generally speaking, looks like that was not a great idea. And that time diversity matters, and it's mattered before and it'll matter again. So in this market, I would always advise people to think about that. And the fact that we are hearing the same thing that you're hearing, Alex, of like, you have to get into these great companies. But power law will suggest that it is highly unlikely you're going to have a fund of 20 power law companies. Statistically, that actually, it kind of goes against the definition of power law, right? So when you see math, Nick, when it's the 100x multiple on every company to produce a 3x fund, the GP needs to raise their bar on what they think is great, or they're not playing the game of returns that Alex is talking about. And so as an LP, the same thing is coming true. But because the fundraising isn't as active, the dialogue isn't as, I'm not in that dialogue as often. So it's this really weird mixed bag of goods. But yes, there's a lot of 2020-ish comparisons going on right now. It does feel that there's, I don't know why we hesitate on the words. Venture is an industry of hype and bubbles. And learning how to manage that is critical if you want to be a great investor. Because every, 5-8 years, we get one. And it's this intersection of the next wave of innovation that produces it, and some great things will come out of it. So don't not play, but you should know your business. And I've always find that the weirdest parts of people being an investor and not knowing the business that they're in. And that's my spicy take for the day.
I was just thinking, as you guys were both talking, I was thinking about like gambling culture permeating every single part of society, every single asset class. And I wonder, like, I think macro cycles and also technology cycles seem to actually be moving quicker than they have historically, like shorter cycles. And so I wonder now if venture and technology will actually have like much shorter cycles than they have historically. So like 2021 was a top, like crypto moves in 4-year cycles typically. So I wonder if maybe like all of venture like ends up becoming these like 4 to 5 year like big booms and busts. And so maybe this is the new normal. And by the way, if it is the new normal, the benefit is that managers, founders, everybody in the ecosystem actually begins to have a much better feeling of where they might be in the cycle. So that's the benefit. Like I have this theory that all the best traders in the future will be kids that grew up trading crypto because they learned unbelievable lessons very, very quickly through the cycles.
God, I love that. Oh, that's awesome. Well, you've helped me become a much better crypto investor by helping explain the cycles to me. So, and it also has implications.
I think for what it's worth, I think there's a lot of toppy stuff happening, whether it's the revenue multiples or people feeling like they need to play the game on the field, which I've always viewed as like really sort of mid-curve thinking, or meme stocks coming back, or crypto hitting all-time highs. The crypto treasury companies, they're called DATs. They're just like basically SPAC companies that are buying crypto. Like if that's not a top signal, I don't know what is a top signal. Yeah, I think there's a lot of top signals. But also, again, maybe the cycles are just much shorter.
Thank you to Sidecar for supporting this episode. On Origins, you hear how GPs and LPs make decisions, from fundraising strategies to what drives long-term performance. Behind every one of those decisions is execution, and that's where Sidecar comes in.
Sidecar helps VCs launch SPVs and funds in a fraction of the time, at a fraction of the cost, without compromising on compliance, reliability, or customer service. Their platform automates key back-office tasks like LP onboarding, KYC, and reporting, so managers can stay focused on raising capital, building portfolios, and earning LP trust.
Alex, let me ask you this. When you're looking at managers now, I know you're focused on early stage and smaller AUM. Are you focused on emerging managers, or is it more size and stage focus?
Good question. Okay, so it is more focused on size and stage, but and so we've done a few funds that I would say are like not one or two that I would say are not emerging. They would probably be considered established at this point, but they're still small. Like they're not growing. They have consistent fund size. So as a matter of fact, our strategy is pretty much all emerging managers. But in terms of what we consider our strike zone, it's more about fund size and stage than it is about which fund vintage.
Perfect. Because I want to ask you both this question, which is, Nick, when you were talking, my first thought was about how fast investors replicate what the one next to them was doing. And your point about technology becoming table stakes, I realize you're talking about the innovation cycle of the technology itself, kind of like in crypto. But I'm also seeing a huge amount. People always replicate others they think are smart, right? Like way back in the dark ages when Andreessen came out, which funny was not dark ages because I'd already been in venture for a long time, but I'm old. Everyone ran to have a platform team. And now when you're seeing people use AI inside VCs, we're seeing a very fast proliferation of people using it. So I think the speed of that when it's software driven matches exactly what you said. We're seeing that kind of replication very fast. And so what is an advantage one day is table stakes, I don't know, how many days later, very fast, because it's software time frame, not human time frame. And so Alex, I was curious, when you're looking at your emerging and established VCs, does that matter? Like, how are you assessing that in this market? Because the technology is moving, VCs are replicating, not in volume, but like sort of thinking through how to be better at it. Does it matter? Do you stick to your knitting? Like, how are you parsing this? Because we're seeing a whole range and I don't have one answer. So I'm curious how you answer it. And I'm curious, Nick, how you're thinking about it as the token GP on here.
I think you're always asking the same question. Like sometimes there's this distinction between like, oh, emerging managers and they're so much harder to diligence because they have limited track records, and established managers, they're so much easier because they have this track record and you go diligence that track record. It's like any track record that anybody has that's meaningful is like 5 to 10 years old. Like that was from investments they made, let's say 5 to 10 years ago. And so it's easy to get like, I think like maybe a false sense of comfort based on a track record. I think like you're constantly asking yourself, like, are these people well positioned to generate venture scale returns right now? Like, do they have the fund size now? Like their fund size before when they had those great returns might not be the same as their fund size now. Their fund math then might not be the same. Their team and team size might have changed. Like the ecosystem has evolved. The categories they're investing in may have changed. There are so many reasons why some established firm with a track record may not keep up the performance they had in the past. And so I'm constantly thinking about like anyone I meet, regardless of where they are in their evolution, like, are you in a position to generate venture scale returns now? Do you have sort of increased odds of generating those returns right now? That's what I'm asking myself. And so, yeah, if it seems like they're not evolving with the times and venture has moved on from a strategy like theirs that worked really well 10 years ago, like maybe they're not the right fit for us, even if like their fund size is the same, but they're not well positioned for this strategy anymore like they used to. Like, regardless of emerging or established, I'm constantly thinking about the same questions. I just have slightly different information to work with to answer the questions. That's how I think about it.
We had David Clark on a few episodes. I'm sure you know David, Alex. And I think he invests across the spectrum, but he also loves these big established funds. And I've been a skeptic historically of that returning what venture needs to return. But I will admit, like, you look at something like a Figma recently, and you look at some of those big funds' returns. And you're like, well, maybe like a $1 billion fund can 5x or 10x. Now they were smaller funds then, so maybe that's the difference. But curious how you think about it, Alex. I know you probably have some bigger funds, but lean also in the small spectrum. Yeah, like do examples like Figma prove David's case?
So here's how I think about this. First response is like, I don't ever want to be pitted against Dave Clark. So like, I think he's done a great job. I love his commentary and data. So like, I just reject the premise here. But first, I think there is like persistence in venture returns. I think there's data to support that. And I've not seen that broken down between like big funds or small funds. I suspect it's typically folks who start small and get bigger. Second is like, yeah, funds with a track record maybe are more predictable, but as a general matter, that to me means smaller range of potential outcomes, like maybe less likely to outperform, like you were mentioning, Nick, and like maybe less likely to 5 to 10x, but they're also than a smaller fund, but also like less likely to lose LPs money. And you still, in every case, need to ask yourself, like, is this fund size with this fund math, with this team able to like reach a level of fund performance that I would be happy with as an LP? And what types of exits need to happen for me to get those outcomes? And at some point, yeah, it probably feels a little far-fetched, but who knows? You're going to get someone's going to get a Figma, and someone's going to get an OpenAI, and someone's going to get like these big outcomes that like their fund can be great, but there are so few of those companies. And there's only so much ownership these funds are getting in them. Their fund sizes are growing. So I do kind of wonder, like, yeah, yes, theoretically, statistically, the chance is greater than zero. Like any of these big funds are going to be a 5 to 10x fund. It's just really, really hard. So then you would say, okay, but like a fund with a low track record, like that's not predictable. Or with a limited track record, I mean, that's like very unpredictable, right? And I'd say like, well, yes, if by that you mean there's a broader range of potential returns. And if you're like, well, no, Alex, just like if you were picking one at random and you didn't do any work on them, you're just like, I'm going to find my average $1 billion plus fund, and I'm going to find some random $1 billion plus fund, and I'm going to find a random emerging manager fund. Which one's likely to do better? I'd be like, the big fund, so much safer. But most funds in venture like don't end up doing well. That's what the data shows. And so I don't think about this as like, I'm just picking because they have a limited track record. Oh, our picking is just random. And so we're picking funds that have like less predictable returns. I don't think that's how this is going. So like what we're doing and what I think Beezer's doing is like, no, we can source and identify and get access to small funds that have significantly increased odds of outperforming. They are very unlikely to be in like the bottom 2 or 3 quartiles of the asset class. It doesn't mean it can't happen. It's just unlikely. So like, yes, picking at random, these funds are more likely to lose LPs money, let's say. But I don't think that someone who's been doing this for a while and has real expertise and sorry, this is becoming too promotional, but like who can kind of navigate this, I don't think that it's so much less predictable. And I think the upside is much easier to attain because the fund math is so much more compelling. You need much smaller exits. Much smaller exits are meaningful to fund level returns. If you happen to get one of like the big winners of a given year, like sure, your fund's going to be amazing, but like you don't need those to have an amazing small fund. And that's a big part of this. So the last thing on my mind is like, why is anyone investing in this asset class in the first place? Like it's so illiquid. There's so much risk. Like the only point, in my opinion, is like, I mean, the primary point is like, if you can outperform all the other asset classes where you're investing. And to me, like, if you have increased odds of getting in the best small funds, that to me really justifies the risk and illiquidity.
Well, I would ask you a question that was the premise of why we did this big research, but everyone kept telling me venture is broken because all these big funds are doing seed and early stage. I'm going to make a wild assumption that you do not think this is true, or you would not have started Slipstream. Like your actions sort of speak for yourself. But how are you seeing these, and Nick, please speak to this because you're living it. People compete in this market because to your point, there are a lot of companies being done by these big funds. It's not that they're not. It's just you obviously believe that there's ways of doing small dedicated funds and being very successful, because to your point, if you're not going to be very successful, why are we doing venture? Venture is not a business of a 5% IRR and 2x back in 20 years. I will just tell you that LPs will rotate out eventually because they need money, unless you're investing for other reasons besides getting money back, caveat. So I'm curious, given today's dynamic in the market, how are you picking managers that you think can do this? And Nick, what are you seeing? Because it is true, there is a lot more activity by large funds at seed and then Series A. But for this conversation, let's focus at seed.
Let me just provide a little more context. The title of the post, Beezer, is Venture Broken.
Yes, because that's what everyone kept telling me. Venture's broken. Literally LPs are asking me this, like, we should get out.
It was a fantastic post, but essentially what it showed was, I forget what the exact percentage, but 50% or so
loosely
of
speaking,
early stage, $2 million plus seed rounds are getting done by big multi-stage firms now. I would add to that, by the way, YC doing 1,000 companies, and those companies coming out of YC at very high prices on safes, which I know you didn't include in your data. So back to you, Alex, like, how does a small manager compete against that? And what do you look for? What are the 3 or 4 things you look for where you're like, okay, I do think actually this person could win in that market environment?
Yeah, it is a great question. Let's talk about like whether they can compete, and then like how can they compete? Like, is it even possible right now? And I think like there are 2 questions on my mind there. It's like, one, can small funds still get access to like great companies, or are they just all being gobbled up by the big funds basically in the first fundraising round? I think the answer is yes, like for 2 reasons. One, at the earliest stage, there are plenty of great companies and great founders that are not consensus yet. And those are opportunities for the smaller funds. But the second way I think that happens is like plenty of great founders would be consensus, could raise from larger firms, but they realize that at the earliest stage, they should be raising from venture funds focused on the stage that the company's at. And they choose the smaller funds instead of the larger funds. If they get access to those companies, like, can these funds still like significantly outperform? And I think the answer is like, yeah, you can have really compelling fund math. Like, you can have high ownership relative to the size of your fund, and like you can have billion-dollar exits or smaller, return a whole small fund. And so I think like the preliminary question, like, is it possible? I say yes. And the second question is like, okay, well then how do you do it? And like, are there a few things that we're looking for in the funds that we're investing in? Yeah, like there are a few. And there was a separate Beezer, we sort of talked before this about, can you give us some examples of like how folks are distinguishing signal from noise and how they're doing this at an early stage? Like, can you provide examples, which I feel like is often not included in podcasts. So I will give some examples here. So what am I looking for? Like, from a sourcing perspective, I'm looking for sort of 2 big categories of things. One is like increased odds of getting into the right companies that like become great companies. And 2, a portfolio construction that can like significantly outperform, that can generate like significant outperformance at the fund level if they have a portfolio of great companies. Most of the like sort of interesting, harder stuff is like in the first bucket. It's like, do they have, from a sourcing perspective, like, is there reason to believe they're getting to great founders at or before inception or really early? And I'll give some examples in our portfolio and some outside of our portfolio. Is there reason to believe that like these people can pick on their own? They are not relying on social proof from other VCs. And when they pick on their own, they might be the only VC in a round. They might be the first to commit, even if they're not leading, and they might like actually just lob in a safe or something. Like, is there reason to believe that when they're acting on their own, they don't need any sort of comfort from other VCs coming in, that they can invest in great companies? From a winning and sort of adding value perspective, which are related, like, I'm thinking about, are there sustainable competitive advantages they have that cause founders to pick them? Sometimes that's domain expertise, could be operating experience, could be any number of things. So those are like the big things I'm looking for really early on to like kind of sift through and that like guide any investment decision we make. Some examples of these, like, who's really well positioned in a market like this? Like, we invested in Joshua Browder's fund. He's on the interviewing committee for the Teal Fellowship. He sources founders so early, like, there is no noise at that point. There is no consensus. Like, there are probably not many other VCs involved. He is, from a picking perspective, evaluating them from his experience as a venture-backed founder himself. He's adding value that he know, like, in ways that are relevant to their founder experience based on his founder experience. So like, he's really uniquely positioned to see folks, high quality founders early on, invest before they really get to the market. It's a really compelling strategy that I think can work well in this market. A second one, like Comma Capital, is another fund we recently invested in. It's like they have built a really strong, engaged community. They are creative about engaging the community. And the community is like technical talent that can go start companies and work at their portfolio companies. And they are able to get in front of these founders early in their journeys, often before company inception. They get color on those founders to distinguish sort of which ones are the right ones to focus on before they're starting a company. So like at the time they're starting a company, Comma's like so well positioned, and it helps them hone in on the right founders and kind of avoid the noise. And like they get to conviction on their own, like they'll be the only investor in the round. Like others not in our portfolio who over the years I've come across and just think are doing a really good job. Like Base Case has done a great job. Walkabout's doing a great job at this, like sourcing really early. Anyway, those are some thoughts that come to mind about like, how do you compete in this market? But like, to me, you need that portfolio construction too. Like you need a compelling portfolio construction that can generate solid returns without these amazing outcomes, amazing companies. And if you happen to have one of these amazing outcomes, I mean, the fund level returns can become pretty crazy.
We've debated this over the years. I think the big firms are here to stay, and that's been I think a unknown in the last number of years. They have so many people. They're totally price insensitive. Like those are hard behemoths to compete with. And then I actually think the other real challenge is Y Combinator, which we haven't really talked about much, but like they're investing in 1,000 companies a year that come out of Y Combinator and are raising at valuations that make it very, very, very difficult for small early funds that are targeting X amount of ownership to make that work. Now I do think, to your point, Alex, like who are the people in the firms that are sourcing really, really, really early? Like they should be finding the company before they decide to go to YC, and folks do that, and that happens. But post YC, I think that it's become very difficult for small funds that are targeting some amount of ownership to invest in those companies. Your two examples of with Comma and Josh Browder are really good ones. Like I think there will always be a place in the ecosystem for small funds that really, really, really care about the craft and about winning to carve out some portion of the market for themselves. And I think my perspective comes down to, this is similar to maybe a founder evaluation. I think as a GP, you can tell pretty quickly who are the other young, it doesn't have to be young, by the way, but hungry, motivated, willing to put in the extra hour, the extra day on a weekend, the extra thing to give themselves a chance to win.
No, I actually think this is an artisanal, relationship-based industry, and I think it will be that for a long time. And I think over a period of time, you show to the market, you show to founders and other VCs that like you are the GP who these founders want to work with. And it's how you engage with the companies that you're investing in, how you help them, and how you kind of impact the curve for them in some way. It's how you, over time, hopefully build a portfolio of companies that they admire. And they kind of want to be a part of that. They look to you as someone who's worked with all these great founders. They want your experience. They want to be in that community. And then it becomes this virtuous cycle where like the best founders of the last generation are helping you stay in front of the best founders in the next generation.
Thank you so much. I'm not going to actually say anything because that answer was incredible. And I want to close with it because it was great.
Let's do part two. I feel like we just scratched the surface.
I would love it. I love talking to you guys.
Thanks for listening to Origins, the show where we discuss the venture ecosystem through the lens of myself, a GP, and Beezer, an LP.
Be sure to tune in next time for a bonus minisode where Nick and I unpack our thoughts from today's conversation.
You can find that right here in this feed. And while you're there, please rate and review the podcast. It's super helpful for other folks looking for venture insights to find our show. I'm Nick Chirls.
And I'm Beezer Clarkson, and we'll be back soon. Thank you for listening.